I'm not too sure about you, but personally, I'm getting pretty excited around Alphabet, which is the parent company of Google, and the opportunity that the stock is offering to investors. Of course, only to those that are not afraid of catching the falling knife. Because if you were to track back its performance over the last 3 months or so, Alphabet actually went into a bearish territory or bear territory, while from its all-time high, it has actually collapsed in valuation by more than 20%. But anywho, I'm not too sure whether this is the first video that YouTube has recommended to you around Alphabet stock, because I do know of a few creators that I follow closely that is basically talking about this investment opportunity. But I think I'm just not going to spend too much time to outline the entire investment thesis around Google Cloud, around search, around YouTube, and how they're going to be dominant. As you can see in the preview on the left, I only have 7 slides today. But more importantly, I'm just going to cut through the BS, tell you why the market is basically punishing Google's valuations today, what they're afraid of, and why I think that these worries are not justified. And more importantly, on the second half of this episode, I'm just going to do a quick discounted cash flow to see what's the risk-reward opportunity here and what exactly is the market expecting and pricing into Alphabet's share price today. So to answer the question, is this the downfall of Google? So before we go into it proper, just full disclosure, I'm just going to share with you my entire exposure. I did update the subscribers of my Substack last week on the 8th of September, where I've added to both my LV and Alphabet position, where based on last week's numbers, Google actually makes up around 6.66% of my entire portfolio. For those of you who are interested, link is in the description. You want to join my Substack to know my most updated thoughts, my portfolio updates, and basically any resources that I think is helpful to you. I've also attached a screenshot of the past transactions that I've bought, starting all the way from September of 2022. And I guess it's a 2-year anniversary. Technically didn't have a full-time job back in 2022 and only started working in the second half of 2023. But anyway, I'm slowly contributing to the portfolio. I'm adding to positions that I think has interesting risk reward. And Google, even at today's much higher share price, I think is fairly interesting for serious shareholders. So what are the challenges around Google today, and why is the market selling it off? I think there are 3 primary core reasons. First, it's really the idea of ChatGPT and friends, which include Llama, Microsoft Copilot, whoever it is, basically upending consumer patterns and behavior, where they're dubbed as the Google search killer, as they're diverting attentions away from the traditional 10 blue links. I think it's fairly intuitive to think about why ChatGPT and friends are going to kill Google search. Because long story short, Google is in the business of monetizing attention. What they're doing is basically aggregating information for you to do easy information retrieval. And in the process, because of this huge attention funneling to its platform, they're able to offer space and real estate to people that wish to advertise. And through that, they're able to generate leads for these merchants and then convert them and to bring in sales for many of these advertisers. So long story short, lesser attention means lesser time and lesser real estate to be monetized, which means that Google search will be irrelevant or probably will be killed sometime down the road. The second key problem is really just the idea of regulators. The EU antitrust fine to the unfair monopolistic practices that was alleged by the $20 billion payment to Apple, and the trial of Google's AdTech business, where the Department of Justice basically said that Alphabet has a monopoly in the AdTech business. And last but not least, it's really the idea of a weakening and a deteriorating corporate culture. Google really seemed to have lost their mojo, and Google search was that last great invention before the acquisition of YouTube, and they are losing out in this entire AI's arms race. And when a company's name is being used as a term, I think it speaks volumes in terms of how integrated and embedded it is in everybody's lives, where more and more knowledge workers are relying on ChatGPT instead of just the traditional Google search. And the second sub-point is, and there's not much innovations or breakthrough coming out from other bets of the Google's portfolio. So management seems to be sleeping at the wheel, and investors are getting jittery about it. So out of these 3 key challenges, you have to rank them in terms of priority of how concerned I am as an investor. ChatGPT as the killer is probably the most important factor. I want to know whether Google's core search business will be affected. Secondly, it will be the corporate culture. And thirdly, it will be the regulations and regulators trying to break up Google. Regulations are not as big of concern because it's the same movie being played over and over again. And of course, I'm not saying that the regulators are at wits' ends and they're unable to do anything, but I think through history, we have already seen that what they're capable of. Sure, they can levy fines and the companies can appeal. And if you look into search specifically, I think if you look into ChatGPT, Microsoft Copilot, and even Meta Llama AI, they are the golden boy for the legal team of Alphabet to argue that there is no monopoly or no monopolistic practice at all. So that's not really a very big concern. On the second part about a weakening corporate culture, I think a lot of these are very intangible. They are soft factors, which can only be seen after 5, 10, 15 years. So I think let's just put more focus on this idea of GPT and how OpenAI is basically destroying the search business itself. So personally, I've already started integrating GPT into my workflow. And let's not forget, the productivity boost is immense. However, it adopts a complementary or supplementary role rather than replacement, where you don't need things to be accurate or even right. There is still a significant hallucination problem as a ChatGPT user, and if you need anything serious, GPT can help with structure and with guidance, but not with facts and real research, which still needs to be done by locating its source and going down and going back to Google search. So here is my own analysis and my own theory. So let me make my simple case on why I think Google's ads business will remain relatively unscathed, despite this seemingly reduction in attention real estate as attention is being diverted away. So I've made two simple subpoints on how I think it will destroy Google's ad business. Firstly, it's if and only if the ROI, which is the return on investment of the ad spend, is greatly impacted. That's when Google will lose business. Or secondly, when there's a huge pullback in spending. So the first point is relatively simple. Let's take an example where today I'm a merchant. Let's say I'm in the business of selling headphones. And I allocate $1 million budget per year in terms of advertising dollars. And I spend on mainly the big three, which is Amazon, Meta, and Alphabet. And really, I think at the end of the day, Business 101 is that I want to drive for profits. And in order for me to drive profits, I need to drive sales profitably. So I really just allocate my budget based on who gives me the best ROI in terms of my ad spend. And there really is just this limited pool or limited real estate of advertising space out there, whether is it from Facebook, whether is it from Amazon, or whether is it from Google. So let's presume that in the case or in the scenario where Amazon gives me the best ROI, followed by Google, followed by Facebook. But let's not forget, whenever you ramp up your advertising spend, the ROI starts to decrease. So I wouldn't want to just put all my eggs in one basket just because Amazon gives me the best ROI. And once I start spending 100,000, 200,000, 500,000, a few $1,000,000, that's when the ROI starts coming down. And then I need to start exploring different platforms, which maybe in this case, Google is able to drive me better conversions or better ROI on the same amount of ad spend. That's why I tend to spread out my bets and to take advantage of all the different ad architecture. So in this case, let's really think about it. Now GPT is stealing out attention from Google search. But let's also not forget the underlying system that is operating behind Google AdSense or Google's ads business or architecture, which is an auction system. So ultimately, it's underpinned by this economic principle of demand and supply. If the largest advertiser decided to leave and to not bid for this brand keyword, the brand keyword will become very cheap and then somebody else will step in, which is the second largest bidder. He will probably start pouring money in to bid up the keyword again until a relatively acceptable or comfortable return on investment on their product itself. At the end of the day, advertisers are only concerned about one thing and one thing only, which is whether this is going to be profitable for me to continue spending money on this platform. And in my brackets, I did say that it can only come in two ways that will destroy Google's ads business. Firstly, it can come from competition. So competition in this case, you might say that, OpenAI and ChatGPT might be coming in to eat Google's lunch. But the matter of the fact is, ChatGPT is not opening up or not creating an ads architecture or ads real estate. So advertisers are unable to bid for eyeballs or attention on their platform. And in fact, maybe even Google's real estate, because of this perceived competition, is going down, which means that advertisers might be spending even more dollars to chase the same amount of eyeballs. Maybe they do have to switch over to other competitors like Amazon and Meta that is able to achieve better ROI. And because it's an auction-based system, the advertisers and also the ad platforms are going to find a new equilibrium, and the advertising budget is just going to be shuffled between the big three, and to see, from a merchant's perspective, who's able to offer the best ROI. And the bigger question would then be, is Google still able to convert attention to sales and benefit from the returns on ad spend? And if they are, then advertisers has no reason to leave the platform. And the idea now of ChatGPT basically taking on Google search just means that they are basically hollowing out a more digital or ads real estate unless ChatGPT is able to figure out a new way of ad monetization. If not, it just means that the ads real estate is going down, it becomes more competitive. Either advertisers pull back their spending because they don't see the ROI, or it just becomes more competitively priced and marketing budgets just get reshuffled again. And on the second part is really just the idea of the ad architecture erosion, where you can basically draw parallels when you saw Apple cracking down on Meta's tracking because they were unable to prove and to provide their ROI for merchants. That, I think, is a greater problem and ultimately a better solution. And I think the second part, which is this idea of a pullback in spending, which, long story short, could be attributed to recession. So I'm not going to spend too much time talking about the recessionary pressures that might come to the US market, because if that really is coming into play, then I think all bets are off. So that's not my bigger concern. So I think the bottom line takeaway here is to really not just buy into the storytelling and the narratives that is being sold to investors, but also to have a better appreciation of the business model, the economics of the business, who are the different stakeholders, how are they benefiting, and what ultimately is going to affect the profitability and the revenue and the growth of the company itself. I think just case in point, I just extracted the last 10 quarters of how Google has been performing. And just look at search. Everybody have been saying that ChatGPT is the search killer. ChatGPT was announced at the tail end of 2022, and they were given 6 quarters to basically kill off search. But in fact, if you do just look at the advertising revenue being derived from search itself, they're just growing in lockstep, growing healthily, and they don't seem to be slowing down. So there really is this very interesting phenomenon where, no doubt, I think ChatGPT is slowly chipping away at search dominance, and you can see the monthly users also just slowly climbing up, while at the same time, Google is still able to profit heavily from its search business. So I think both things can be true at the same time, but I think one important factor that I wish to point out is that if you were to compare Google as an investment opportunity pre-2022 versus post-2022, Google used to be that search dominant advertising giant. Nobody's going to dethrone them. But post 2022, Alphabet stock become a buy and hold and monitor, because there really is an imminent threat with how GPT is developing. So before we talk about the valuations of Google today, Seeking Alpha, they're running a mid-autumn special right now where you can sign up with the link below and you get a 7-day free trial while also locking in a subsequent renewal rate at $239 per year. After October 1st, the prices are going to increase to $299 a year. So Seeking Alpha Premium, they're basically a platform that provides stock market news and analysis. So I use a lot of their data and analytics to do my projection, to look at estimates. And I think one very key factor of why Seeking Alpha is different from other platforms is really the myriad of different analysis from different viewpoints. Specifically, at least for myself, I like to listen to dissenting viewpoints. So that is a great equalizer to know that I'm not stuck in my own echo chamber. So if you're interested to take advantage of this mid-autumn special, you can lock in your first year at the discounted rate of Seeking Alpha. Link is in the description. So I'm just going to quickly run you through on how I usually create a very simple DCF on how I look at the valuations of company today, and basically my thought process. So I'm just going to duplicate one. Let's say I'm going to duplicate this one from Lululemon, and today the date is the 15th of September 24. So specific for Alphabet, let's go to Seeking Alpha to basically pull out the historical numbers from 2018 to 2023. So going to Seeking Alpha, I've already pulled out Google's page. I'll just go to financials and to look at the cash flow. So since DCF, it's a discounted cash flow model, I just want to arrive to the free cash flow of Google. So I'll just go down to the cash from operations. I'm looking at it from 2018 to 2023. So I'll just extract these numbers here and go back to Excel. I'll just plug it in cash flow from operations. And next up, I'll go over to capital expenditure to look at the capex cycle of the company itself. So similarly, 2018 to 2023. And as you can see, the growth rate basically populates itself. You can ignore the formatting for now. On the cash flow from operations over the last 5 years or so have been a little haphazard, where you have 13, 20, 40%, and then flat, and then now back to 11%. Similarly for CapEx, it's on an increasing trend. I think in 2018 was 25 billion. Now it's already at 32 billion. So currently, if I want to do a projection for 2024, we are already 3 quarters into 2024. So I think a lot of the guidance and a lot of the numbers have already been set in stone. So going back to Seeking Alpha, based on the financials, we already have a TTM figure, which is based on trailing 12 month. So cash flow from operations on a trailing 12-month basis is at 105. We have the last quarter, and I do believe that Alphabet will probably grow in the range of, I guess, 5% to 8%. So let's just put 8% and say that they grow to $110 billion in this case. So moving on to CapEx, CapEx is actually the tricky one here. So looking at CapEx, they actually ballooned from 32 billion to 44 billion. So it's because of this exponential increase in the CapEx, probably due to the AI CapEx cycle. They're building a lot of infrastructure for their Google Cloud. And I think in one of the earnings report itself, they said that per quarter run rate now for CapEx, Google's taking up around 13 billion. So if you just annualize 13 billion, that's close to like $50 billion. So we are going to expect a huge increase in terms of the CapEx cycle, probably because of this huge buying of NVIDIA chips and whatnot. So I do think that CapEx is going to balloon from here, which is in line of what has happened in the trailing 12 month of 44 billion. For the entire year of 2024, I think it's closer to 50% increase in CapEx. So that will bring the CapEx number up to 48 billion, which will have a huge impact to its free cash flow, which is also one of the main concerns of many of the bears around Alphabet today, saying that, because of this huge CapEx cycle, free cash flow or the bottom line that is going to be returned to shareholders is going to take a hit. So largely speaking, I can understand where they're coming from, but I do think that many of these CapEx spending is growth CapEx in nature rather than maintenance CapEx. Meaning to say, I do not expect Alphabet every single year from here on out into perpetuity. I do think that they tend to work in cycles, and right now they are ramping up and they are in this uptick in terms of cycle. And even if you to look at it from the historical perspective, just looking at it from a 10-year chart, you can see that their CapEx all the way from 2014, in this blue line, you can see that it went from 11 to 9 to 10 to 13 to 25. And then there's this huge bump up, 25, then down again to 23, 22, 24. They don't go up in lockstep. Means that CapEx also increased by 10 to 20% every year. That clearly is not the case. So at least based on my projection, I think that maybe out into 2025, they can continue increasing their CapEx as well, maybe by 15% to $55 billion, even at this elevated rate. And maybe they'll come down to closer to 5% for the next 2 years, and then stepping up again their CapEx at 10%. So that's generally on the CapEx front. Specifically for the projection of the cash flow from operations, I just wanted to take a closer look in terms of how analysts are going to project their earnings. So let's assume that in terms of earnings estimate, or at least cash flow from operations, the margins down the line, they're going to follow closely to the revenue estimates, which is how they grow their top line is going to translate to how they grow their bottom line. So out into 2025 and even 2026, they're expected to grow around 10, 11%. And from 2027 onwards, the number of analysts actually dropped down to 12 and 10, which might not be as accurate. So let's take these two numbers, which is 11% out into 25 and 26. So 11, and maybe I'll slow it down to 8 and 8 for 2027 and 2028. And in terms of the multiple, we then need to attach an exit multiple on Google as a terminal business after 2028. So how do you basically get a historical perspective of how Alphabet is trading? Basically, you go to charts and you go to select metric, you go to valuations, and you try to find out what's the price to cash flow of Alphabet over the last 10 years or so. Update the charts, extract down to 10 years. So I'm not interested in the price return, so let's X this away. Let's look at this orange chart. So over the last 10 years or so, you can see that Alphabet, or Google in this case, is range bounded from the lows of 15 times to the highs of, I guess, 20 times. So everything outside that range, I would presume as abnormal. So back in 2022, because of that bear market and everybody is basically selling down all the tech companies, Google was trading as low as 12 times price to free cash flow. And at its peak, they were trading at above 23, 24, 25 times. So I guess in a conservative way or conservative estimates, let me change this to 15 to 20 times. I do think that a long-term free cash flow multiple of probably 18 times would be conservative. It's still in that range. And I guess it's for a big tech company with such a great margin profile, that's probably a fair multiple. So for weighted average cost of capital, it's basically a discount rate. I tend to set it at 10%. I think for most companies, their WACC, for established companies at least, is probably lower than 10%. So you can keep it at 10%. And now to just briefly understand what's the current share price of Google today. So going back to summary, Google is at 158. So let's input that into 158. And the current market cap of Google is at around $1.94 trillion. And if they just do a quick Google search, they roughly have around 12.3 billion shares outstanding. So fear not, there was some formatting issues because of the plus and minus. But anyway, I think total shares outstanding is around 12.3 billion. At a current share price of 158, it checks out where the current market cap is around $1.94 trillion. So given these current projections that we have, the price target of Alphabet is actually closer to $149, and it's kind of overvalued by negative 6%. So I think you might be wondering, hey, why do you think Google is such a great business, or why is it such a great opportunity, even though it's like, I guess, fairly valued or maybe even slightly overvalued? So I think I just wanted to do an additional layer of analysis here, where to look at the free cash flow margins of Alphabet over the past, I guess, 5 years. So I include revenue and I guess the free cash flow margin that I want to kind of investigate here. Going back to Seeking Alpha, I just wanted to copy out the 2018 to 2023, the revenue and what's their margins. So just doing this, dividing the free cash flow with their margin. Pulling it out here, I just wanted to also understand, given the current free cash flow, or at least the past free cash flow margin from 2018 to 2023, it's between the range of 17% to 26%. In the name of being conservative, let's take the free cash flow margin of 21%. It seems to be the median. So if you were to just look at it from a 21% margin at a current free cash flow expectation or projection of 2028, just doing the free cash flow of 90 billion divided by 21%, you can see that the expected revenue should be around $430 billion. However, when we do the projection, or at least the estimates of 2028 right now for Google, based on the estimates of Seeking Alpha, you can see that the expectations here is 517 billion. So I'm being extremely conservative here based on my own expectations or projections of free cash flow. So 430 with 510, that's I guess 20% difference. So I am kind of underscoring in terms of the potential of them trying to grow their cash flow from operations and also trying to bump up their capex even at this heightened figure. So even at a very conservative estimate, I think that Alphabet is at near fair value territory, which is why it gave me the confidence to continue adding to my position by averaging up to the position, and I do expect Alphabet to really outperform from here and to give us more than 10% CAGR in the years ahead to come. So that's basically just how I look at this entire risk-reward opportunity and how Alphabet is trading at in today's valuation. So do feel free to leave in the comment section down below on what you think will happen, and do you think it's a good entry point to look into Google today. And also, if you're interested, I'll probably leave a link to this spreadsheet in the link down below where you can download and to play around with your own projection. So with that, I'll see you guys in the next video, but more importantly, and hopefully, I'll see you guys on the moon. Goodbye.